Today, we're going to talk about one of the biggest and honestly most overlooked challenges that Bitcoin is facing. It's called the security budget. And it's not just a future problem. It's a problem with a countdown timer baked right into the code. Let's get into it. This quote right here, it just nails it. The idea that Bitcoin's greatest threat isn't some hacker or government, but something inside its own DNA, that's a pretty wild thought, right? And that's the core conflict we're going to unpack together. All right. So, before we can understand the threat, we gotta understand the defense. You see, Bitcoin security is way more than just fancy, unbreakable code. It's actually this incredible economic model that works like a suit of armor for the whole network. And this right here is a really important distinction to get. Think of it like this. The cryptographic security, that's the laws of physics in the Bitcoin universe. It sets the hard rules, right? You just can't counterfeit coins. But the economic security, that's what makes all the players, the miners, actually want to follow those rules. It's the game theory that keeps the whole system honest. Now, this is a super important concept, miner commitment. Miners can't just, show up with a laptop and start making money. No way. They have to sink massive amounts of real money up front into these super specialized computers that can't really do anything else. This basically locks them in. They are financially committed to Bitcoin succeeding. And this number, wow, it really shows you how much skin in the game we're talking about. Back in 2019, researchers figured the total commitment from miners was over 500,000 Bitcoin. That is the massive pile of value they stand to lose if they do something to hurt the network and crash the price. It's an unbelievably powerful reason to protect the system. Okay, but here's the twist. Here's where we start to see a potential crack in that economic armor. The main thing that pays miners, the very incentive that creates this whole security model, well, it's designed to slowly disappear. You've probably heard of the halving, right? Well, this is it. Every 4 years or so, the block subsidy, that's the amount of brand new Bitcoin that gets created with every block, gets sliced right in half. And as you can see, that reward just shrinks and shrinks over time. By 2036, it's going to be less than a single Bitcoin per block. And this chart, this is why this is such a huge deal. Just look at it. Right now, almost all of a miner's income, like 99% of it, comes from that block subsidy. Transaction fees are just a tiny, tiny sliver. So their whole business model depends on a paycheck that's programmed to get smaller and smaller until it's basically gone. So that brings us to the core dilemma. It's the million-dollar question, isn't it? If the main reason miners spend billions on security just fades away, what takes its place? How does the network possibly defend itself then? Now, this isn't some new, shocking idea. People in the Bitcoin community have been debating this for years, and they are seriously divided on what it all means. The whole debate really shows two totally different ways of thinking about Bitcoin's future. So on one side, you've got the classic bullish take. The logic is pretty simple. Miners have huge costs, right? Electricity, hardware. So they have to sell a lot of the Bitcoin they earn. The halving creates a supply shock. It instantly cuts the flow of new coins getting sold on the market. So if demand for Bitcoin stays the same, or even goes up, well, basic economics says the price has to go up too. But then you have the counter argument. This side says, hold on a second. The amount of new Bitcoin being mined, that's the flow, it's already tiny compared to the total amount of Bitcoin that already exists and gets traded every single day. That's the stock. So from this point of view, cutting that tiny flow in half is just a drop in the ocean. It shouldn't really have a major impact on the price of the whole asset. Okay, so with those two viewpoints clashing, let's explore the first potential solution for the long term. This is the vision of a future where Bitcoin's security is basically paid for by how useful it is. For this to actually work, a few things have to happen one after the other. It's like a chain reaction. As the subsidy goes down, transaction fees have to go up to replace that income for miners. For fees to get high enough, you need a ton of people all competing for the limited space in each block. And for that to happen, Bitcoin needs to be able to handle a huge, huge volume of transactions. Yeah, it's not that simple though. This path has some really serious hurdles. First off, demand for transactions can be super volatile. One day it's high, the next it's low. That's not great for miners who need predictable income. Second, things like the Lightning Network, which are great for scaling, might actually pull transactions off the main chain, meaning less fee pressure, not more. And finally, a world that runs only on fees could create weird new problems, like something called fee sniping, where miners might even be tempted to attack the blockchain to steal big fees from past blocks. Yikes. So let's look at a completely different idea.
Some would say it's way more radical. What if the solution isn't about tons of small transactions, but about the price of Bitcoin just going absolutely vertical?
$10 million for a single Bitcoin. I know, that sounds completely insane, but there's actually a real economic theory behind a number like this. It's a view that sees Bitcoin as the answer to a huge global problem.
People call this the waterfall analogy, and it's a really cool way to think about it. Imagine all the money in the world, hundreds of trillions of dollars, is sitting in assets like stocks, bonds, and real estate. The problem is, all of those assets are constantly being diluted. They're like leaky buckets. This argument says that eventually that capital is going to flow out of those leaky buckets and look for the one place where it can't be diluted, the one with perfect, absolute scarcity. And that's Bitcoin.
And this table just drives that point home perfectly. Look at it. The supply of gold goes up by about 2% every year. Real estate grows even faster. But Bitcoin, its future supply increase is hard-coded to go to zero, period. It's the only major asset on the planet with a truly finite, unchangeable supply. So you might be asking, how does a $10 million Bitcoin actually solve our security problem? Well, it's just simple math. When the block's subsidy gets tiny, say just 0.1 BTC, if each Bitcoin is worth 10 million bucks, that reward is still worth $1 million. That's more than enough to pay for all the security the network needs.
So here we are. We have two totally different visions for how Bitcoin makes it in the long run. And this isn't just a small disagreement. This is a fundamental fork in the road for what Bitcoin is even meant to be. Let's just put them right next to each other. On one side, you've got Bitcoin secured by utility. It's a bustling digital city, and its security is paid for by all the economic activity happening inside it. On the other side, Bitcoin's secured by pure value. In this version, it's more like a digital Fort Knox, and its security is funded by the insane, immense value of the asset itself.
You see, the answer to the security budget question, it's not just some nerdy technical detail. It will literally define Bitcoin's identity for the next 100 years. It's a choice between being the world's go-to system for payments or being the world's ultimate form of savings. And so that's the question we're left with. Is Bitcoin's destiny to become a super-fast medium of exchange secured by the fees from a buzzing global economy? Or is it meant to become an incredibly valuable, slow-moving store of wealth secured by nothing more than its own profound scarcity? The path it takes? Well, that could change